Hello and welcome back to the channel. Today we're going to talk about a mailbag question that came in from a viewer asking about how to treat the proceeds of a RRIF that fell into their deceased parents' estate. I'm going to step you through the question, some of the considerations that the viewer asked me to cover, and I'm going to walk through the answer that I provided to them in email. Hopefully this situation might help you if you're going through a similar situation with an estate. And if we haven't met yet, my name is Mark Walhout, and I created this channel to share ideas and concepts that I'm using to help people with retirement every day. If you want to get more videos like these, consider subscribing to the channel and hit the bell icon so you're alerted when new videos are posted. So I'm not going to read the question that the viewer sent in word for word, but I'll paraphrase it because I did include some more personal information. But basically, the viewer had a parent pass away this year. The RRIF fell into the parent's estate. The beneficiary was not updated on it when the first member of the couple passed away. So the deceased parent had their RRIF fall into their estate. The proceeds of the RRIF were subject to probate, and now the funds are available to withdraw. And the viewer wants to know how much tax they should expect to have to pay as the executor on the proceeds of that RRIF. Who's responsible for making that payment? Is it the executor, the child, or the estate directly? And the final question is, how long does the viewer have to make the tax payment as the executor without incurring any additional taxes or penalties? Some additional details I'll layer in. So this individual is the only beneficiary of the estate. They had no siblings. There's no other heirs that they indicated when they wrote me the email. And so it's basically the executor and the beneficiary are the same person for all intents and purposes. So I provided this person with a few pointers, and I'm just going to sort of step through them right now. So in terms of taxes, planning for the income tax bill. So the value of the RRIF, the amount of money that's in the RRIF account, is considered to be taken into income immediately when the deceased person passes away. So all the money that's in that RRIF account will be added to the final tax return and will be totaled up with all other sources of income that the deceased had in the year of their passing. So this year, other sources of income, assuming for the moment, and I don't know based on the way that the question was framed, but we're going to assume for a moment that they were an elderly person that passed away, the parent. So they may have other sources of income that include Canada Pension Plan, Old Age Security, maybe private pensions. If they had a taxable account, they might have dividend, interest, and capital gain income. So the value of that RRIF will be combined together with all those other sources of income and form, the total sum of taxable income or be used to calculate their final tax bill. And so what I suggested to this person is if you have a sense for what those other sources of income are going to total up to in this year, the year of the parent's passing, you can use a tool to calculate roughly what that tax bill will be. Now, if this person or if this is your situation, if you're working with an accountant currently, you can ask them to run you a simple tax projection. If you're working with a financial planner, they can run you a simple tax projection as well. But the tax bill arising from the realization of that RRIF in income in the year of death may not be the only source of income taxes in that year. So you just want to make sure that you've covered off your total tax bill, not just the tax bill that's going to arise from the RRIF when considering how much should be set aside as executor to pay that tax bill. So the second question was, does the tax payment to the CRA come from her as the executor / beneficiary personally, or does it come from some other source? And my answer was typically a tax bill will be made as a payment or a check drawn from the estate bank account. So one of the jobs of the executor is to set up a separate bank account for the estate so that they can receive any benefits and payments on behalf of the deceased. So typically a final tax bill would be paid from the estate bank account. I did a little bit of digging. I've not heard of many cases where the executor personally will make that final income tax payment. I won't say that it's not possible, but I would say check with your accountant before you assume that you'd have to make that payment personally. If you've done all the work to set up the estate bank account and manage the estate as the executor, chances are you'll just make that final tax payment for the final tax return from the estate bank account. And then the third question had to do with timelines. There's a due date for final tax returns based on when the deceased passed away during the year. So for individuals who died between January 1st and October 1st in the calendar year, their tax return and tax payable is due on April 30th of the following year. This is assuming that the deceased did not operate a business. If the death occurred between November 1st and December 31st, the tax return and tax payable is due 6 months after the date of death. So in this individual's case, if the death occurred in 2024, they'll have at least until April 30th of 2025 to file the final tax returns. calculate the taxes owing, and pay that final tax bill before they have to worry about incurring things like late penalties and fines. In the question, the person highlighted, I'm able, based on what the lawyer is telling me, to take this money out now, but I'm worried about investing it and not properly planning for the tax bill. It's very prudent to just hold off and wait until you understand what that final tax bill is before you go ahead and spend that money or invest it in volatile assets. And even to wait until they've gotten a clearance certificate from the CRA. Now, in this person's case, if they're the only beneficiary and the executor of the estate, they may be able to, avoid some of this risk because there's not going to be other parties that they would need to collect from if there was later a reassessment. But it's probably just good, prudent planning to just wait until that final tax return is filed and that tax bill is paid. The clearance certificate is received before they go ahead and do anything with those proceeds. So hopefully this answer's helped you with your planning if you're in a similar situation. If you have a question for me, you can simply email me. My email address is in the description section below. I've also included a link for you to upload or just type in your own mailbag question. If you like this video, give it a thumbs up. Leave me any questions or comments below. Thanks for watching all the way to the end, and I'll speak with you soon. Take care.